back to Market on Close. We have just a few minutes left in our trading day. That means it's time for the big picture. So we will welcome in our team from Charles Schwab. Joining us today is Nate Peterson, the Director of Derivatives Analysis at the Schwab Center for Financial Research. Nate, great to have you back on the show here. First, let's just start with some takeaways on the day.
Yeah, takeaways is that, you would think that minus 911,000 in a downward revision in BLS jobs growth there would have been enough of an excuse to get the market to, provide some bit of a pullback. But in fact, now it looks like, NASDAQ Composite on track to close a new high, S&P as well, new closing high. Just characteristic kind of bull market price action. When you're moving up like this and what would be, one would presume in the face of negative news. Now, you could say the jobs data is old, but, we've also been seeing signs of some labor market weakness in the last two non-farm payrolls reports and some downward revisions there as well more recently. And perhaps that has to do with AI, Marley. And so that, and maybe the market is just saying, look, as long as we have right now, GDP growth, if you look at the Atlanta Fed nowcast 3%, last quarter earnings, we had 6% top line, 12% bottom line growth. You look at the FactSet EPS for 2025, 10% EPS growth for this year, 13% next year. The bottom line is we had these secular growth stories within that are being powered by technology and productivity that are translating into the bottom line for the market, which that is where the focus is. The market was able to set aside tariffs. The market is able to set aside potentially stubborn inflation. And now it feels like, yes, we could have some job market weakness, but maybe that has to do with higher productivity and businesses not needing to hire as many humans. They can replace that with technology. We've got the Fed potentially on our side. The only thing I think potentially we have to watch out for is if inflation starts to creep higher and we move to more of a stagflationary type of environment, because we don't get the Fed cuts that the market expects and inflation starts to kind of move the wrong direction. That certainly isn't priced into stocks here at all-time highs.
And, we do have our inflation reports coming out tomorrow and Thursday, with PPI coming out first this month, then followed by CPI. Like you said, if inflation creeps back into this equation, knowing that we already are starting to see some cracks in the labor market, one, how do you expect the markets to react if PPI does come in hotter like it did last month, or CPI comes in hotter as well? And also, how do you anticipate that impacting the Fed moving forward?
Yeah, so how would I expect the market to react? To your point, if we go back to last month's CPI and PPI, both came in, like core on the CPI came in hotter than expected. The PPI, I believe, was roughly double what the estimates were. And the market largely was able to overlook that and continue to just grind higher. So I think that the market has just been in the glass half full type of mentality. As long as earnings continue to come in, as long as it looks like growth is intact, as long as the AI secular growth story looks like it has legs, and the AI adjacent plays are also demonstrating that that's translating to growth. So if they come in hot this week, sure, there's, it depends on by how much, to what degree is it coming in above estimates. I think I saw, 0.3 for CPI, 0.4 increase on PPI. You annualize that doesn't get you near the Fed target that you need. So if we come in hotter than that, the market could negatively react to that. But more importantly, then, it's going to be, next week at the FOMC, how does the Fed interpret that? How does the Fed change its stance? Would it, it has the dual mandate. Of course, they're acknowledging the weakness in the labor market. But they've also acknowledged the stubbornness of inflation. If it starts to creep up and show more trend, so to speak, then it's going to be up to how the Fed interprets it, which I then think the market will take their cue from. Because right now they're saying the Fed kind of gave us a dovish cue that they're ready to start cutting back at Jackson Hole. So unless the Fed changed their tune, I think the market's largely going to be fairly resilient here at all-time highs.
So the dovish tune, the tech sector boost, the AI investment runway, all contributing to this bullish thesis for the market. But we are now in September, which is historically the worst performing month, and seasonality is often bearish. Do we have to be concerned about that, or have we been bucking historical trends so regularly that that shouldn't be on the table?
Yeah, I think it's important to acknowledge. I think that most it would be too easy if we just sell off every September, Marley. I mean, I think it would just telegraph that too easy. So normally, I think because of what happened in April this year, where the market sold off so dramatically, and then was able to climb the wall of worry in the face of higher tariffs, in the face of some kind of questionable inflation data, in the face of some weak labor data. So the market has been in this mentality of being able to climb the wall of worry. And I think that's including seasonality this time. But having said that, it's the inflation data this week. It's the FOMC tone that comes out next week. It's the tariff situation. Potentially, we could get some clarity around the Supreme Court ruling around those tariffs. Maybe not by September. I think the deadline is early October. But any of those could have the potential to provide enough of a catalyst to say, oh, yeah, it's September. How did I overlook this? And then maybe we get something like a 3 to 5% pullback. But the price action right here just suggests that the pain trade and the path of least resistance still appears like the market wants to go higher.
Well, Nate, we appreciate you joining us and welcome back to this show. We've missed you. That's Nate Peterson from the Schwab Center for Financial Research.